Now we're going to examine 1 and 2 bar price patterns. These are formations that develop, as their name implies, during the course of 1 or 2 bars, and they're usually signs of exhaustion. That means that while they occasionally appear on the charts as continuation patterns, they're usually of the reversal type. I think they're very much underrated as a trading tool, and I sincerely hope that this brief explanation will pique your interest.
Historically, these patterns were called 1 and 2 day patterns or 1 and 2 week patterns. But with the advent of intraday trading charts, the title inside days, outside days, and so forth no longer encompasses the majority of these formations. Therefore, we're going to be using the term bar rather than day to describe them. A key factor determining the significance of any pattern is its size. These 1 and 2 bar patterns do not take very long to form, so they only have a short-term influence on prices. For example, a pattern consisting of a 1-day bar would be expected under normal circumstances to affect the price over, say, a 5 to 10-day period. A 2-bar pattern created from 10-minute bars would influence the trend over the course of the next 50 minutes to an hour, and so forth. Even though this is a relatively short period, the more I study these patterns, the more impressed I become with their ability to reliably signal short-term trend reversals. When a trend has reached maturity and the long-term technical picture is consistent with the turn, these 1 and 2 bar patterns often develop literally at the final turning point of the move. In this sense, they don't signal major trend reversals in and of themselves, but become dominoes or reverse dominoes, as they are the last straw in the camel's back that tips the long-term technical balance in a new direction. But more of that later. We tend to think of the signals in these patterns as either buy or sell indications, and that's fine as far as it goes. However, it's equally as important to make an attempt at judging their quality, because not all patterns are created equal. This means that we should consider their signals in terms of stars or shades of grey. For example, pattern A might contain the characteristics of a specific formation, but pattern B could reflect them in a far stronger way. Thus A could be a 2-star pattern, but B might be classified as 5 stars. Technical analysis deals in probabilities, so a 5-star signal would offer higher odds of a valid trend reversal than, say, a 2-star, and so forth. Just as there are no guarantees in technical analysis, there's no guarantee that a 5-star signal will always be valid, or a 1-star followed by a weak move, merely that the odds favor it. What we are doing is hunting for clues as to the strength and significance of a change in sentiment being signaled by a particular reversal phenomenon. I could say the word help, for example, but if I shout it from the rooftop, you'll get the message that I need help far more clearly. Well, the same principle operates in a marketplace. Consequently, 1 and 2 bar patterns should be interpreted as shades of grey rather than as black or white, because some patterns offer stronger signs of exhaustion than others. There are several interpretive ground rules that apply to all of these 1 and 2 bar formations. First, in order for them to be effective, there must be something to reverse. This means that top reversals should be preceded by a meaningful rally, and bottom formations should be preceded by a sharp sell-off. As a general rule, the stronger the preceding trend, the more powerful the effect of the 1 and 2 bar price pattern. 2. They generally reflect an exhaustion point. In the case of an uptrend, such patterns develop when buyers have temporarily pushed up prices too far and are in need of a rest. In the case of downtrends, there is little, if any, supply because sellers have completed their liquidation. Such patterns are almost always associated with a reversal in the prevailing trend. 3. Not all patterns are created equal. Some show all of the characteristics described later in a very strong way. Others will just reflect a few of the characteristics in a mild way. What we might call a 5-star pattern with all the characteristics is more likely to result in a strong reversal than, say, a 2-star pattern that has mild characteristics. It's therefore necessary to apply a certain degree of common sense into their interpretation, rather than jumping to an immediate conclusion that the presence of one of these patterns guarantees a quick profitable price reversal. 4. It's helpful to see 1 and 2 bar patterns being confirmed by another technical event. Examples would include the completion of a larger pattern, or more likely the violation of a trend line. Such events not only add significance to the pattern, but also increase the odds of a valid signal. Now it's time to take a look at some of these formations. Let's start with outside bars. An outside bar is a wide one whose trading range totally encompasses that of its predecessor. These patterns develop after both down and uptrends and represent exhaustion. An example of a top is shown here. See how this bar totally encompasses its predecessor. See how for the last 7 bars of the advance, the buyers were very much in control. Then, on the outside bar, they push the price higher again, and market participants think that they'll get more of the same. However, by the end of the session, it's the sellers who've managed to push prices below the low of the previous bar. Now, in order to give the bar some validity in the spirit of a seller victory, it's important for the close to develop in the lower half of the bar. The lower the better, because that indicates a more decisive victory for the sellers. The opposite would be true in a declining market, where we see a bar which totally encompasses its predecessor, again hinting at a reversal in the fortunes of the buyer-seller relationship. This time, in order to give greater credence to the bar, and therefore the buyers, the close should be in the upper half of its trading range. I mentioned earlier that we find many instances of these 1 and 2 bar formations, but some have stronger characteristics than others. Now we'd all agree that the Edsel has the characteristics of a car: 4 wheels, a steering wheel, brakes and so forth. However, so does a Mercedes, but there's no doubt which is the stronger car. So what are the characteristics that give the outside bar a better chance of success? I say better because most of the time these patterns will work for you, but since we're dealing in technical analysis, there are no certainties, only probabilities. So here are a few pointers in that direction. The guidelines for deciding on the potential significance of an outside bar are as follows. 1. The wider the outside bar relative to the preceding ones, and the greater the distance between the open and the close, the stronger the signal. This arises from the fact that the outside bar is supposed to reflect a change in the balance between buyers and sellers. This is an acceptable outside bar in the left-hand part of the chart. However, this one on the right is much better because it's far wider and indicates a much more significant battle that's been going on between buyers and sellers. Even better if the contrast is greater between the open and the close. So let's move the open up and the close down. No doubt who won this battle. 2. The sharper the rally preceding the outside bar, the more significant the bar. In this respect, this outside bar meets the requirements, but this one on the right is a much stronger example. It stands to reason that if a change in sentiment is going to take place, there must be something to change. Therefore, the stronger the trend preceding the outside bar, the stronger the implied sentiment dominating that trend. When opinions move to an extreme, they're very vulnerable to a change. In other words, if the preceding trend is strongly positive, all the bullish arguments will be fully discounted. Thus, at some point, buyers will become exhausted and the market vulnerable to profit-taking. The steeper the trend, the easier it is to take profits. The same would be true in a downtrend. The sharper the preceding decline, the greater the chances that the outside bar will work. The more bars encompassed, the better. In most situations, the outside bar will only encompass one other bar. However, when it encompasses several bars, the signal that the balance has shifted from buyers to sellers to buyers at a bottom becomes that much stronger. The encompassed bars become a small price pattern in and of themselves. If I convert the bars into rectangles, you can better appreciate this encompassing characteristic. The greater the volume accompanying the outside bar relative to previous bars, the stronger the signal. Now we're looking at a 60-minute chart for the Dow. At the end of the decline, we see a nice outside bar. And if I uncover more of the action, you can see that it was followed by a sharp rally. Just remember, there's nothing here that would have told you that the advance would be so strong. Just an outside bar that signaled a reversal in trend. Note that in this instance, it was possible to draw in some resistance, which when surpassed, acted as confirmation for the outside bar. Sometimes we see more than one outside bar. The more the merrier, as far as I'm concerned. Here's one at the end of this decline. Then, another 4 bars later, another that encompasses the following 3 bars. Note the expansion of volume and the fact that the violation of this trend line confirmed the whole thing on the same day. Not surprisingly, prices advanced following this event. This chart tells a different story. Here's a perfectly good outside bar following a rally. A bar that closes close to its low, in fact. Prices decline for a short while, and then we see another outside bar. What should we do? Well, at this time, we should remember that prices are determined by people, and people can and do change their minds. Consequently, this outside bar has the effect of cancelling out the other one. Remember, had we gone short based on the bearish probabilities, the bullish pattern cancels this out. Just as well since prices rose. Finally, here's another excellent outside bar that completely failed to work, most probably because it was a bearish bar in a strongly bullish trend. I find that if these patterns are going to fail, a great deal of the time it's because they're triggering counter-cyclical signals, a sell in an uptrend and a buy in a downtrend. Here we see a daily chart for the Dow Jones UBS Commodity Index. It experiences a really strong outside day. It's preceded by a sharp advance, so there's plenty of profit-taking potential. It's a very wide bar and opens near the high and closes near the low. Later on we see a consolidation outside day. It too indicated lower prices because it closed near the low for the session. Finally, this chart features a bullish outside day. Note that it occurs on record volume, a very strong signal. Actually, this was the NYSE composite in July of 2002. This was not the ultimate low, but it did experience more stocks registering new lows than at the actual bottom, which was made 3 months later in October. Record volume, by definition, doesn't happen very often, and this was also a strong supplementary signal that sentiment had reversed in favor of the bulls. Summary of outside bars. 1. One bar preceded by a persistent up or down trend. 2. It totally encompasses the previous bar. 3. The wider the bar, the more bars it encompasses, the greater the volume, the stronger the signal. And 4. A new trend sometimes takes several bars to get underway.